Okay, well, good morning, everyone, or good afternoon to those of you in the Eastern States, and welcome to our 2024 financial reporting update. We're very glad you could join us. My name's Ralph Martin. I'm the National Technical Partner at RSM Australia, and I'm delighted to be joined by Catherine Bell, who's a partner in our ESG and Climate Services team. So we've got a lot to cover today, but before we do, a couple of things. One is we will be sharing the slides with everyone who attends after the session, so yeah, don't worry. We will be sending around a PDF with a full copy of the slides that you're very welcome to use for reference. The second thing I want to say is we love questions, so if you have questions at any time, do just click the Q&A box at the bottom of your screen in Zoom, and that'll come through to us, and we will do our very best to answer as many questions as we can. But let's get straight into it, because we have a lot to cover this year. It's actually a pretty exciting year in terms of financial reporting developments. Now, when I was originally planning this session a couple of months ago, my initial plan was to let Catherine go first, because Catherine's going to talk about mandatory climate reporting, and that is probably the biggest change to financial reporting in Australia for a generation. So that's probably the most important topic to talk about at the moment. But then in April, a little change snuck through the Senate, and it's the most urgent change because it's actually effective for 30th of June 2024 year ends. So yeah, this one's happened pretty quickly. The legislation only got passed in April, and it's something that already applies for 30th of June 2024, the new Consolidated Entity Disclosure Statement. So what is it? Well, the reason it applies quickly is that it isn't a change to accounting standards, it's a change to the Corporations Act, and to Section 295, which is the bit of the Corporations Act that talks about financial reporting. And it affects all public companies, So that's all listed companies, all public unlisted companies. But the third one there is the one that everyone misses. If you're a company limited by guarantee who is not registered with the ACNC, then you are caught by this. If you are registered with the ACNC, the Charities and Not-for-Profits Commission, then it doesn't apply to you, because when you do that, all of the financial reporting requirements of the Corporations Act disappear, and only the ACNC Act applies. But yeah, companies limited by guarantee that are not ACNC registered are caught by this, because they are a form of public company. So what does this actually require? Well, the big change is that there's a new statement within the financial statements called the Consolidated Entity Disclosure Statement. So it's a new statement. It's not just a note. It's not just some wording. It's a new statement. And what you have to include on it is, for every subsidiary that you have the subsidiary's name, its corporate structure, what country was it incorporated in, and what percent do you own. Those are the first 4 bullet points. So far, fairly easy. Then we get to the harder bit. Whether the entity was Australian resident for income tax purposes, and if the entity was foreign resident, which jurisdictions was the entity tax resident in. So yeah, as I say, the first 4 bullet points there are pretty easy, but the last 2, I've been doing this presentation around Australia for the last month or so, and talked to a lot of directors, and what they tell me is that's not always an obvious question to answer, particularly if you have subsidiaries that are operating overseas. Because remember, tax residency doesn't necessarily follow legal residency, and you can be tax resident in more than one jurisdiction. So to take a simple example, if I'm an Australian company and I have a branch, not a separate company, a branch in New Zealand, I'm probably tax resident in New Zealand as well. And tax residency can be difficult to determine because it depends on tax law in every jurisdiction that you operate in. So look, if you're a purely domestic entity and all of your subsidiaries are in Australia, they're tax resident in Australia, they only operate in Australia, then this is a fairly simple thing to prepare. But if you have subsidiaries operating in other jurisdictions, it might actually be fairly difficult disclosure to prepare because you need to understand the tax residency of every single subsidiary that you have. So in some instances, you may not actually need to seek professional advice from your tax advisors about this. If you have no subsidiaries, then there's a specific wording that you have to include, a statement that basically says that because you have no subsidiaries, that particular section of the Corporations Act doesn't apply. So, as I say, can be quite a difficult disclosure to put together, but a very important one, because another thing that's changed in the Corporations Act is there's a change to the director's declaration. Now, we're all familiar with the principle that when you have a set of accounts, they have to be signed off by the directors as true and fair. But there's a new line that needs to be put into director statements saying that the consolidated entity disclosure statement is true and correct. True and correct. So that's a little bit of a different thing to true and fair. Now, true and correct is not actually defined anywhere in the Corporations Act, but it's how tax returns are already signed off. And the way I would interpret it is true and correct really doesn't apply any principle of materiality. So for the consolidated entity disclosure statement, basically it has to be right. And you have to include all of your subsidiaries, even if they're immaterial, even if they're dormant, you have to include all of your subsidiaries and make sure you're satisfied with all of the details about their tax residency. So, as I say, potentially quite a challenging thing to prepare. It is also subject to audit because it's part of the financial statement, so it's subject to audit like any other part of the financial statements. However, some good news is that the list of subsidiaries is only subsidiaries as at the balance sheet date. So you don't need any comparative information. You also don't need any information on subsidiaries you gained, subsidiaries you lost during the year. All we care about is what subsidiaries did you have at your balance sheet date? Those are the ones that need to be listed in your consolidated entity disclosure statement. Now, if I go back a couple of slides, slide here, the first four items there are actually not new disclosures, the name, corporate structure, percentage ownership, and so on. If you prepare consolidated financial statements, you will already have a note disclosure that lists your subsidiaries. So you may be thinking, well, can I combine the two? Well, while the legislation isn't absolutely clear on this, our view would be no, you can't, and you wouldn't want to either. The reason I say that is, firstly, the legislation does insist that this is a separate statement. The second reason I say that, and perhaps the more important one, is because of this true and correct sign-off requirement, you want it to be very clear exactly what information you're signing off as true and correct, and not inadvertently suggest that you might be signing off the entire financial statements or any larger bit of the financial statements as true and correct. You want it to be just a consolidated entity disclosure statement and nothing else. So it should be a separate statement. It should be on a separate page. While there's no rules on exactly where it should go in the financial statements, my view would be that the best place to put it is at the very end, after the end of all the notes to the financial statement. But if you're a listed company, before you get into the top 20 shareholders and all of that additional information. So that's where I'd put it. That will mean that some of the information in that statement is duplicated again in the notes, but that's just the way it's got to be. That's the better way than trying to combine it with the existing note disclosure. Okay, if you want to know any more about the consolidated entity disclosure statements. You can go on our website. I've put the link there and the QR code as well. We'll send there's an article there that gives you a bit more information. It's a very good article. I know it's very good because I wrote it. So yeah, the article's available. Do go and refer to that if you have any further questions. Okay, so that's everything I have to say on consolidated entity disclosure statements. I'm now going to hand over to Catherine, who is going to talk us through the new climate reporting requirements. Okay, Catherine.
Testing, sorry.
That's better. That's better.
Okay. It's always a good thing when your headset crashes just before you're about to speak. So anyway, just like to say good morning, good afternoon, good evening, wherever you are in this virtual world. And thanks, Ralph, for the introduction. And yes, a bit of a short update on what's coming just around the corner. We talk about a countdown to climate reporting. I think in some respects that countdown is almost over. Ralph, if you could just switch to the next slide, we can just get started. So I think if you have been living under a rock, you will know that this is obviously coming down the line very fast, and it's essentially there has been some delays with the rollout, but ultimately this is happening. It's still yet to have its final sign off, but ultimately 1st of January 2025 is when this is going to kick off. And as Ralph did mention, this is going to have fundamental impacts on businesses in all sectors at all levels, and we'll get into that a little bit. But first, to start with, it's really important that companies understand where they are. The Australian Supporting Sustainability Reporting Standards is essentially the framework in which Australia has contextualised and made local pronouncements of the IFRS S1 and S2. We are leading with climate, but not at the expense of all other ESG metrics. It's essentially a framework that will be built, that has been built to scale and remain agile as more disclosures will be required in this non-financial space. But right now, the focus is on climate reporting. It will be phased in. Companies will have to trigger 2 of the 3 categories, employee, assets and revenue, and that will determine whether which year you will be reporting in. In terms of who is covered, essentially anyone under the Chapter 2M Corporations Act. It includes listed and large private, those that are NGA reporters. Government will also be included and will be essentially integrated in a different way, but ultimately across the states, they're piloting large emitting government entities at the moment, and other state departments will be picking it up per state. Financial institutions and managed investment schemes, super entities. What is being given a free pass at the moment is not-for-profit, ACNC, registered businesses. However, saying that may change in the near future again. This is all coming quickly in terms of how this particular legislation is being rolled out, and essentially there'll be a lot of work that companies need to do to disclose. So thanks, Ralph. If we could just switch to the next one. So some fast facts here, just in terms of what this reporting standard entails. As mentioned, 1st of January 2025. It was originally 1st of July 2024, so just a few weeks off, but it was pushed back. Ultimately, that doesn't change those that are calendar year reporters, but for financial year reporters, it has given a 1-year relief. Saying that though, and I know that most companies probably need that 1-year relief, but it does take a lot of time to actually get the data and the analysis in place for companies to disclose. So the message really is, if you haven't started, start now. Climate first, however, as mentioned, broader sustainability topics are still required to be considered as part of the risk management assessment. And so, in the past, a lot of this information, the expectation was that it was contained in the operation, the OFR part of the annual report, if material. This is going to be required alongside your financial report under a sustainability report banner. It will be separate for now, and this will include any climate risk disclosures or other ESG or nature-related disclosures if you choose to disclose those on a voluntary basis, but climate risk will be first. As mentioned, it's going to be designed to be scaled and flexible, understanding that more disclosures will be coming down the line as focus shifts from climate to nature, which we're seeing a lot of noise in the market about at the moment. So it's essential that sort of the same principles to financial reporting are applied to climate risk reporting. So the idea is that it does, the timing around reporting climate is aligned to financial reporting. Over time, this will be ultimately integrated, as it does have to integrate or understand the financial implications of the financial disclosures. There are metrics that are mandatory in the first year, and that is Scope 1 and 2 emissions. By year 2, it'll be Scope 3 emissions. These are your value chain emissions, and they are quite complicated and complex in terms of how to and what to collect. So again, considerable work that's going to be required by companies to do that work. Part of the legislation requires that companies look at two possible futures when it comes to scenario analysis. So the reporting does entail future-looking analysis, and this is part of why we're doing this. Climate change is having some severe impacts on our markets, not just locally, but globally. And so what investors are looking to understand is a company's ability to adapt to what is a changing market. In the first instance, it's obviously the transition to a low carbon world. But second to that is the physical extreme events, climate events that are occurring more and more. So these scenario analysis futures is all about how do you map the future of your organisation and how do you pivot based on those two scenarios. One of those scenarios has to be aligned to the Paris 1.5 degree targets. This is to provide some consistency across the market, comparability, that it probably will be under review, given that the 1.5 world is possibly not a realistic scenario at the moment. Liability, there will be understanding that there's a lot of data involved in the reporting of climate and broader ESG metrics. Many companies are collecting this information for the first time. It's greenfields. So the quality, the veracity of this data, the government does understand is going to be shady for the first initial period. So there will be some time in which companies are given to essentially ensure that their methods, processes, data becomes more robust. So liability is for about 3 years. Any sort of issues then after that turns to civil penalties. As mentioned, it's really around being clear, concise, and effective, fair representation around the presentation of information in these reports. RSM has developed a research report labelled From Sustainability Marketing to Sustainability Accounting. These are not marketing documents. These are disclosures, just as you disclose on finance. These are non-financial disclosures. So everything must be based on a reasonable basis. This is to avoid any greenwashing issues as such. So really important. We recently heard from ASIC, who we understand have received considerable funding to essentially police these new disclosures in terms of ensuring that the way in which companies are disclosing on this is in line with the legislative requirements around fair representation. So both good and bad, and essentially providing some understanding of where you are on your journey. Thanks, Ralph. Next one. So with the legislation comes assurance as well. And so this essentially tries to map out Group 1, Group 2, Group 3 to give you some idea around where you should be preparing and when you report, and then the type of assurance that will be applied. This is coming very quickly in terms of the assurance requirements over that. Obviously, assurance is there to ensure that the information that is being presented is as correct, and investors and readers of those reports have the confidence that what is being presented is true. The assurance timeline is still under consultation, and I'll kind of come to that in a slide or two. But as you can see, between now and FY30, there will be the expectation that companies from all sectors will be reporting. This convergence of reporting around climate will have widespread impacts across the market. The point that I'd sort of like to make on this one is that given that Scope 1 and 2 emissions will be reported in the first year and then followed by Scope 3 emissions in the second year, the Scope 3 emissions for Group 1 reporters, their value chain emissions will likely pick up most companies in the market. So whether or not you're a Group 2 reporter or a Group 3 reporter, or not even a reporter at all, depending on what your value chain looks like, there will be this domino effect that's happening in the market, particularly around carbon emissions, this requesting of information, because all this collaboration requirement, because one person's Scope 3 emissions is another person's Scope 1 and 2 emissions. So with the level and amount of net zero targets, emission reduction targets from the national, federal level, state level, and then also from a company level, and then from the finance sector, there is this massive push for companies to in the first instance, understand what their carbon footprint is, and secondly, to understand, well, what is the transition plan around how can you actually reduce those emissions? So this will be a big area in the next few years. Thanks, Ralph. Next one. So what needs to be reported? There's a lot here, and it's not my intention really to unpack this. We do actually have a session next Tuesday. It's a 1-hour session where we actually do go through this in more detail. But the way that I'm just going to sort of cover off on this slide is what needs to be reported is essentially the tip of the iceberg. The reporting requirements is really trying to push organisations to embed climate risk as part of enterprise risk management, as part of your strategy, and then understand what are the metrics and targets required to essentially transform your business to understand or transform or your business as a result of a very fast-moving, transforming market as we move into this low carbon, and as public opinion shifts, as business strategy moves towards different products and services aligned to a lower carbon economy. So what does this mean? It means that organisations really need to be setting up the governance internal structures to manage this. There needs to be risk management systems and methodologies that need to be adopted. And there are guidance and approaches that companies will need to start considering, looking through the lens of transition risks and then physical risks, and then the strategy around adopting scenario analysis to really sort of understand or picture what the future looks like for that business, and whether its strategy is aligned to the future that's essentially just around the corner. So lots of internal kind of considerations and development of systems and processes, risk management to disclose against this. So the requirement of skilled people to help through this initial process will be required, and that's acknowledged by Treasury in the legislation, and it will help businesses really to get some assistance on this early in the piece, to set those foundations early, to ensure that this becomes embedded into businesses for ongoing disclosures year on year. Thanks, Ralph. So just some comments on the assurance timeline at the moment. This is also being quickly developed. The adoption of the ISSA 5000 has been essentially agreed upon, and it's in Australia, the AUASB is now is out for consultation in terms of asking around what are the local pronouncements to that assurance standard that needs to be adopted here in Australia. One of the things that we took away from the consultation with the AUASB was around how we do provide assurance over climate risk reporting. Given that there are, forward-looking information, there's uncertainty, and the takeaway really is that there needs to be a robust process put in place around this, as auditors will be looking for completeness, effectiveness, and appropriateness of the approach. As you may have sort of seen for Group 3 reporters, there's a point in which in terms of identifying whether there is a climate risk, you still need to undergo a process to assess that climate risk. So you can't just sort of look at your business and go, we don't see there's any risk. You actually have to demonstrate that you've gone through a robust process of assessing materiality around the climate risks for your business, and that then needs to be disclosed. And if that conclusion is that there is no climate risk, then that's fine, but there needs to be a process in which you can do that. Completeness, again, it's really sort of developing and understanding that there is a methodological approach to climate risk assessment and scenario analysis, and that you may need to call on some climate risk experts to help you in that process in the first instances. But yeah, by the end of 2024, we'll be looking at having something here in place in terms of assurance standards that will cross not only climate risk, but all ESG sustainability topics. It'll be agnostic to industry, it'll be agnostic to the topics and frameworks as well. Thank you, Ralph. So I'll wrap up here, but a couple of key takeaways in terms of what does this all mean, and how is this sort of manifesting itself across the marketplace? Ultimately, it's taken a number of years for the ESG frameworks to converge. It's happening across ESG, climate, and natural capital, which is an emerging space that we'll see more and more of. But ultimately, whilst we have the IFRS S1, S2, which is being contextualized here in Australia and many other countries, particularly around Asia Pacific, it's a very active. A lot of the Singapore, Malaysia, Southeast Asian countries are adopting the process. We do have obviously Europe that has its own approach, which is probably a lot more involved and complex. So it's very important to know, based on where your company operates, what is the reporting requirements. So you'll need to do some mapping gap analysis there around that, and then develop a strategy around how you're going to report and satisfy the various jurisdictions that you operate in. Disruption. climate change is energy transition is disrupting the markets, and this is going to actually have an impact on all business. And again, it's understanding what does that disruption look like through the lens of your own business. What are the risks and what are the opportunities? And so being able to sort of constantly keep an eye on what that looks like, given the speed of the disruption, will ensure that you'll be in a place which you'll be able to drive positive outcomes for your business. The risks globally, we call it sort of a confluence of local and global risks. The indirect risks are the ones to be watching for. Supply chain risks are obviously a huge part of this. Redrawing of trade lines based on carbon taxes, the carbon border adjustment tax in the US. Strategic approaches by governments such as Australia, Future Made in Australia, or the US's Inflation Reduction Act is really having an impact on companies' ability to compete, both positively and negatively. So again, understanding what these rising risks, whether they're geopolitics, how are they going to impact your business and your market, access to market, for example. Always good to finish off on a positive opportunity. When we're in a disruptive market, there is lots of opportunities. So think innovation, think collaborative partnerships, think business not as usual. So I think that's it for me, and back to you, Ralph. Oh, just to sort of add, if you would like to join our session, it is only a few days away, actually, but we will be looking at unpacking exactly what it is that needs to be reported, and some practical steps around how you can actually approach that as well. So thanks again, Ralph, and thanks everyone for your attention. And any questions, I will be hanging around to answer. Thanks.
Great, thank you very much, Catherine. And look, just to emphasize the importance of this, I think the takeaway I would leave you is, yes, we put the reporting timelines and requirements on screen, but I think the market is going to move faster than that. We've already been seeing that. I was talking to a family-owned business, a vineyard down in Margaret River here in Western Australia. So what they were telling me, this was just a few weeks ago, was they're already being asked, because they supply a lot of their wine overseas. They supply it in particular to some of the big UK supermarkets, and they're already being asked how much data or how much carbon does each bottle of wine emit to produce it. And we're going to see an increasing amount of that, particularly for entities that operate across multiple jurisdictions. I was also talking recently to a CFO of an oil and gas company who was telling me he's struggling to find financing for his project. And it's nothing to do with the profitability. The numbers are very good, but the large banks are reluctant to lend to a new fossil fuel project because how that will feed into their own corporate and social responsibility reporting, their ESG reporting, and their climate disclosures. So yeah, the impact isn't just going to be having a section in the annual report. It's going to be much wider and across the whole economy.
Yeah, and that would have been my other main point, is that whilst the legislation, is happening, and it will obviously push companies along, what we're actually seeing is other drivers that are pushing companies to do the work and understand what their ESG footprint is, and being able to, whether it's procurement and tendering opportunities, whether it's the banks requesting information, or insurance companies is another key one that's driving it, or customer preference. It's somewhat the stakeholders that are involved in your business are becoming a lot more louder and demanding around the types of businesses that they partner with, buy from, and work for as well. So employees are also voting with their feet in some respects as well.
Okay, so we've had a couple of questions here. One is if we could share the link for the webinar next Tuesday. We'll make sure to get that out. But also, if you click on the QR code that's on the screen right now, it should also take you there, and you can register. The other question we've had was about assurance over the climate reporting disclosures, and in particular, who can carry it out, whether it's going to be auditors or a different specialist. Now, that's an interesting question because the legislation and the audit standard hasn't been finalized yet. But what I can say is the legislation does require that the audit, and there is going to be a separate audit report over the climate disclosures, is carried out by a registered company auditor from the same firm that signs the financial statement audit. Whether it's the same person or not is actually not entirely clear in the legislation, but I suspect in many cases it will be the same person. But yeah, it does have to be a registered company auditor from the same firm. So it's not something that an entirely separate organization that just does climate auditing could do. So that is going to be a challenge for the entire audit and professional services industry to skill up with the necessary skills to audit this information. And that's why we're fortunate at RSM to have Catherine and several other specialists in that area who are going to be able to assist us with providing that service and training our existing auditors as well to provide it, because it's going to be a significant change. I do emphasize it's the biggest change at least since IFRS came in 2005. It's the biggest change to financial reporting since then. Okay, just a reminder, that's our ESG and climate services team. If you need any assistance with preparing for all of this, you get in contact with us, and we're very pleased to help you. But let's move back to accounting standards finally. Now, just before I get into IFRS 18, I have had a question about the consolidated entity disclosure report and what the audit requirements are around that, what the impact is on the audit report. So just to say that there's no separate or additional audit report on the consolidated entity disclosure statement. It's just covered by the same audit opinion that the rest of the financial statement is. Having said that, auditors are going to have to do a bit of work on this because they're going to need to audit what tax jurisdiction every subsidiary is resident in. And that's not the easiest thing to audit. It's probably going to involve greater use of tax specialists in some audits than there has been previously. So yeah, there's probably going to be a bit of work around that, particularly in year one. But in terms of the actual impact on the audit report, the wording itself doesn't change. Now, let's move on and talk about IFRS 18 and IFRS 19. So if you're an accounting technical nerd like me, it's exciting. You wait 7 years for a new IFRS, and then 2 come along in the space of a month. So let's talk about IFRS 18 first. And look, for the moment, it is IFRS 18, not AASB 18, because it hasn't yet been issued in Australia. Effective for periods on or after 1 January 2027. So 31 December 2027 is the first set of year ends this applies to. But I will talk in a moment about why you need to be thinking about this a lot sooner than 31 December 2027. So IFRS 18, it replaces IAS 1, AASB 101 in Australia, which is actually the oldest standard out there. And that's kind of the foundation standard. That's the one that actually tells you need to have an income statement, you need to have a balance sheet, you need to have a cash flow statement, and so on. And a lot of the requirements have gone across pretty much unchanged into the new IFRS 18, but what has changed quite a bit is the income statement. Because at the moment, the income statement's a bit of a free-for-all. You need to have revenue at the top, you need to have your profit before tax at the bottom, but then how you get from one number to the other, there's actually quite a wide range of ways you can do that. There's relatively few rules, and the ISB did some research on this, and they found they went and looked at 100 listed companies across a lot of jurisdictions. They found of those 100 or so, about 60 of them disclosed operating profit. The other 40 didn't disclose it at all. And then among those 60, there were 15 different ways of calculating operating profit. So what that tells me is while operating profit's a key metric that a lot of investors look at, the level of inconsistency, because it's not a defined term, the level of inconsistency is so great as to make it very difficult to compare financial statements. And the big impact of IFRS 18 is to try to address that issue. So the key change is going to be that within the income statement, all income and expenses are going to fall within 3 categories: operating, investing, and financing. And the way it works is that investing is income that comes from any assets that independently, separate from your main business, generate income. Financing, we generally know what that is. It's obviously things like interest on bank loans. The other thing to be aware of there is it's also the interest component of leases and provisions. Those are the 2 that are easy to miss there. So investing and financing, and then operating is the residual. Anything that's not investing or financing by default falls into operating profit. So that's now a required disclosure. I will say on this, you're probably thinking operating, investing, and financing is fairly straightforward. I'm familiar with that because I prepare a cash flow statement, and that already has those 3 headings. Well, unfortunately, we accountants never like making anything that easy. These are the same 3 headings, but the definitions aren't quite the same for the purposes of the income statement. Okay, so that's the first big change. You now have to have operating profit, and it's defined exactly what it means. The next big change is going to be the introduction of management-defined performance measures. What on earth are they? Well, a management-defined performance measure is any metric that you use to tell the story about how the business is performing. And for the purposes of IFRS 18, we're only interested in management-defined performance measures that relate to income or revenue or profit or any other number that's from the income statement. So the idea is that any public communication you put out, and it can be any public communication at all, can give rise to a management-defined performance measure, because once you have one in a public communication, then what that means is that in the financial statements, you'll also need to include it. So commonly it includes things like adjusted profit, underlying earnings, profit after removal of exceptional items, various metrics that businesses use to tell these stories, which all seem to have the common theme that the profit that they come up with is always much better than the actual statutory profit required by accounting standards. But the idea is if you put any communication, and for an ASX list business, it's going to be primarily ASX announcements, but it will also apply to any other business. It can be any announcement, any press release, and any statement you put on your website. If it has anything about your business performance using any metric like that, then you're going to need to include it in the note disclosure within your financial statements. And what you would need to disclose is why you're using that metric to report about your business, why it's useful, how you calculate it, including if how you calculate it has changed, why has the change been made, and what is the change. And then a reconciliation back to the most directly comparable IFRS defined measure. So if I was presenting EBITDA in my announcements to the market, then in my accounts, I might have to reconcile that back to operating profit. If I'm presenting underlying earnings or earnings after removal of exceptional items or anything like that, I would probably have to reconcile that back to profit before tax. Judgment there, but basically it has to be reconciled back to an actual statutory number in your income statement. So this is why I say you need to think about IFRS 18 a long time before it comes into force, because it comes into force first year ends 31 December 2017. But how do new accounting standards always come into force? Retrospectively. So you also have to adjust your comparatives for 31 December 2016. So what that means, if I go back slide here, is that any market announcement on or after 1st of January 2016, 1st of January 2016 has to, or potentially gives rise to, a management performance measure that's going to appear in your 31 December 2017 accounts. So if, for example, you are part of an ASX listed company and you have a marketing or market communications team, company secretarial division, all of that, you are going to want to train them on the effect of the announcements they put out before 1st of January 2016, i.e. during 2015. So when I put it like that, maybe this isn't quite so far away after all. It's not something you can leave until 2018 to start thinking about. Okay, what else has changed in IFRS 18? Well, there's some new guidance on aggregation and disaggregation. Mostly that's pretty sensible. It just says to aggregate things together. They have to be of a similar nature. The other change that's happened, again, which is a pretty sensible one, is that you can't have other income or other expenses as basically a dumping ground for everything you want to hide. If you have other income or other expenses and it's material, you need to include a note disclosure giving a breakdown and explaining what it actually is. Okay, so that's IFRS 18. If you want to know more, again, read our article. It's there on our website, and we'll also have the link when we send the slides around. And the article gives a bit more detail and actually also has an example of an income statement and how it will look under IFRS 18. IFRS 19 is a bit less exciting in Australia. It's a new standard that allows subsidiaries without public accountability to adopt a reduced disclosure framework, which substantially reduces the level of disclosure they require. Not too exciting in Australia because we've already had a reduced disclosure framework for over 10 years now. And ours is actually more widespread in that it allows all entities that are not publicly accountable, not just subsidiaries, to adopt a reduced disclosure framework. In fact, we've actually gone further than IFRS 19 has in terms of the reduction of disclosures. So what will be interesting to see is whether the AASB, when they adopt IFRS 19 for Australia, they actually change our framework to bring the level of disclosures up to match that in IFRS 19, or whether they leave it as it is. Don't know at the moment. They're having consultations on that currently. Watch this space. Come back to this presentation next year and I shall tell you the answer. Okay, so those are the big two new accounting standards, but there's lots of changes to existing accounting standards as well. Now, a reminder here that new accounting standards are always effective periods beginning on or after a certain date. So the 1 January 23 ones there will be effective for periods for 30th of June 24 year ends for the first time. The 1 January 24 changes will be effective for 30th of June 25. But another reminder that we always adopt retrospectively. So the ones that are applicable for 30th of June 2025, you will, when you get there, have to change your 30th of June 2024 comparatives to be under these new standards. So it's worth thinking about them now, even if you're not going to early adopt. Other reason you need to start thinking about them now is that we also have a disclosure requirement that for standards issued not yet effective, you have to disclose that they exist, that you haven't adopted them, and also what the impact is going to be. There's a few in here that there is potentially quite a significant impact. So firstly, some good news for probably 98% of the people on this presentation. You don't work in insurance, so you don't need to know the details of the new insurance contracts accounting standard. It's applicable for 30th of June 2024, but if you are an insurance company, you should have been preparing for this for several years now. If you haven't, then you're in a lot of trouble, but come and see me. But yeah, I'm not going to go through the detail of insurance accounting. That's a whole webinar in itself. All I'll say is that the previous standard AASB4 was very loose framework, very wide variation in how you could account for insurance. The new one has much more rigorous and rigid requirements about how you account for claims income, how you account for your claims provision, how you account for your premium income, and so on. Okay, next change that does affect everyone is change to 108 and 101. The new definition of accounting estimates isn't that exciting, but the bit at the bottom there is worth noting. So previously we had to disclose all accounting policies that were significant, your significant accounting policies. Now you have to disclose material accounting policies. Is that just semantics? Well, no, I don't think it is. I think material does mean something different. To me, what it means is if you have a material balance in your financial statements, you now have to disclose an accounting policy. Whereas significant, you could just argue, I'm going to disclose my top 5 or my top 10 accounting policies. Deferred tax asset and liabilities, again, this does come into effect this year. I think it shouldn't be that big a change for most people in the TIGOTs. This answers are under the old standard, but apparently it was ambiguous and there was a lack of clarity there. So all it confirms is that if you have any provision for rehabilitation, restoration, environmental liabilities, and make good provisions on leases, that's the one everyone misses, make good provisions on leases, you do have to check, is there a difference between the tax carrying value and the accounting carrying value? If there's a difference, you should be recognizing a deferred tax asset or liability. As I say, I think everyone should have been doing that anyway, but for anyone who hasn't, you do need to do it for this year. Okay, classification of liabilities. This is worth spending a moment or two to talk about. So the key principle on how liabilities are classified between current and non-current hasn't changed. The key principle has always been that in order to classify a liability as non-current, you must have an unconditional contractual right to defer settlement for at least 12 months. So intention, probability, likelihood, all irrelevant. What matters is a contractual right. So if I have a bank loan that I've had for 50 years, it's due to be renewed in 6 months' time, I'm 99% sure the bank is going to renew it, doesn't matter. The contractual term is 6 months, so it must be classified as current. That hasn't changed. What has changed is firstly a change to clarify that the definition of settlement does include not only cash, but also settlement through goods, settlement through delivery of services, and settlement through the issue of shares, unless the conversion option is classified as equity. I'll come back to that point in a moment. The other thing that's been clarified, and I think everyone should have got this answer under the old standard, but they have clarified because people were arguing, is that if you have a bank covenant or a condition and you breach that covenant as at your balance sheet date, then the debt must be classified as current, even if the bank only actually tests for compliance with that condition later. So if you have a bank covenant, you're in breach at 30th of June, but the bank doesn't test it until August, doesn't matter. It still must be classified as current. So a reminder here, if you have bank loans and you're potentially in breach, talk to your bank now, pretty urgently, because it's 12th of June already. Because if you have a bank loan covenant, you breach it on 28th of June, your balance sheet date's 30th of June, and you get a waiver from the bank on 2nd of July saying they're going to take no action, doesn't matter. Because as at 30th of June, you didn't have an unconditional contractual right to defer settlement, so you classify it as current. The other thing to say there is if you get a waiver for your bank, it does need to be a proper waiver. Banks love giving letters saying things like, we note you're in breach of your banking covenants. We don't intend to take any action at this time. I mean, that's nice, but you may as well take that letter and throw it straight in the shredder, because that's how much value it has. Because that's their intention at this time, but their intention tomorrow might change. If you want to classify your debt as non-current, any waiver from your bank has to say something along the lines of, we irrevocably waive our right to take any action as a result of this covenant breach. Okay, the other thing this changes, this change to AASB 101, is potentially the classification of some convertible debt. And I've got an example here of a convertible bond which converts to a variable number of shares. So bond 5-year term, there's no obligation to pay any cash for 5 years. I only pay all the cash at the end of the 5-year term. But the holder can convert it at any time, and it's in a foreign currency. Why is that important? It's because if the bond is in a foreign currency, it won't meet what's called the fixed for fixed test for convertible debt. The fixed for fixed test says that if I have a conversion option, I can only classify it as equity if I'm converting a fixed amount of cash into a fixed number of shares. So in this example, the bond's in a foreign currency, which means the amount of cash I have to pay is variable, because every time the exchange rate moves, it changes every day. So it doesn't meet the fixed for fixed test. So what that means is the conversion option cannot be classified as equity. It must be classified as a financial liability. And that then has a knock-on effect onto the classification of the entire convertible debt balance. Previously, how would most entities have treated this? They'd probably have classified it as non-current, because there's no obligation to deliver cash for 5 years. Now I would say, I've got a conversion option, it's recognized as a financial liability, and the holder of my convertible debt could ask me to convert it tomorrow. They can ask it to be converted at any time. So actually, I don't have an unconditional contractual right to delay settlement for over a year, so I must classify this debt as current. So that's a potential little nasty little sting in the tail for some holders of convertible debt, because I think most holders would have classified this type of instrument as non-current previously. Okay, lease liability and sale of leaseback is a bit of a technical change that's quite niche, so I'm not going to run through the detail. All it basically says is if you have a sale and leaseback, and then you make a modification, you can't end up with a big gain or loss in your P&L. Similarly, supplier finance arrangements is quite niche. So supplier finance is when you get basically someone else to pay all of your trade creditors on your behalf, and then you pay them, and usually because it'll be over a term and there's interest and fees associated with it. Some entities were using that as basically a tool to make themselves look better than they are in terms of paying their suppliers quickly by using supplier finance just before their balance sheet date every year. So to avoid that, now you have required disclosures around the nature and terms of the arrangement, how you use supplier finance, the payment due date, the liquidity risk, and so on. So if you do use supplier finance, make sure you go and read through all of those disclosures and incorporate them. Last thing I wanted to talk about in terms of new standards is the common control transactions. So common control transactions is a bit of a black hole in IFRS. The way it works is if you have a transaction where one business is acquiring another, but they're ultimately common controlled, AASB 3, the business combination standard, will tell you common control transactions are outside the scope of this standard. But it doesn't tell you where to go. The IFRS doesn't tell you anything about common control transactions at the moment. So as a result, two common methods have arisen. There's the acquisition method, which says this standard's outside the scope of AASB 3, but I've got nowhere else to go, so I'm going to apply it anyway. I'm going to treat it as a business combination, fair value everything, fair value all my assets and liabilities, and recognize goodwill. However, probably the more popular alternative is what's called the book value method, which says that that method, the business combination method, is difficult, expensive, and may not give great results for a common control transaction. So instead, what I'm going to do is I'm going to transfer everything at book value, and any difference between the book value of what I'm gaining and the amount of consideration I'm paying, I will take directly to equity, usually within a separate common control reserve, but directly to equity. So no goodwill is recognized and there's no requirement to fair value everything. So the ISB noted that there's divergence in practice around this. There's two methods and then there's sort of different variations on the book value method. So they had a project to address that. And I kind of want to go and work for the ISB now because they had a project to address that. It's worked for 10 years. And the output of that project is nothing. Nothing. They've decided not to engage in standard setting activity after all. They had a discussion paper that was going to turn into a standard, but then they've decided it's all too hard. There's too big a range of views. So there's not going to be any standard on common control transactions. So the existing methods are what we're stuck with. If you want to know more, please go and read my article. You can Google it and find it on the RSM website. It's called Common Issues with Common Control. If you Google Common Issues with Common Control RSM, you'll find that, and it runs through how to account for common control transactions. Okay, IFRIC agenda decisions. What are they? Why am I talking about them? Unless you are an accounting technical nerd like me, you may never even have heard of them. So what the IFRIC is it's a body that sits in London to support the work of the Accounting Standards Board. And the way it works is that anyone, absolutely anyone at all, can ask them a question. But the question has to be along the lines of, hello, IFRIC, I've been reading IFRS and I note that there is an area that's uncertain. It's unclear how to account for a transaction. And as a result, there's diversity in practice. Different people are treating the same thing different ways. Can you sort this problem, please? And the IFRIC can do one of four things. They can say, yes, it is unclear. We'll issue an interpretation to clarify it. There's no new interpretations this year, but there have been plenty in the past around things like uncertain tax provisions, lease incentives, and so on. You can go and read them all on the AASB website. Effectively, they're exactly the same as accounting standards. You've got to comply with them. So that's one option. They can recommend that the Standards Board changes an existing standard or even write an entirely new standard. Those are options 2 and 3. But the fourth option is they can take a decision that say, we are not going to take this issue onto our agenda because we think it is clear how to treat this type of transaction in IFRS, and here's how to treat it. So IFRIC agenda decisions are what I call semi-authoritative. They don't have force of law the same way accounting standards do, but they are considered part of IFRS. Actually, some jurisdictions, not Australia, but some jurisdictions, including the European Union, have legislated to make them part of IFRS. Even though Australia hasn't, you really do have to comply with them. That's certainly what regulators would expect. So the thing that really put agenda decisions on the map was about 2 or 3 years ago, when they came out and said for all cloud computing costs, customization and configuration of cloud computing software, you can't capitalize it as an intangible asset. That was a big deal because previously a lot of people had been capitalizing it as an intangible asset. So that made a lot of people sit up and take notice of IFRIC agenda decisions. So the main one I wanted to cover is the first one because it fits in very neatly with what Catherine was talking about earlier. Reduction of carbon emissions. So what's probably going to be a fairly common scenario here, a company makes a big announcement to the market to say, we are going to reduce our greenhouse gas emissions by 60% by 2029. And then from 2029 onwards, we're also going to buy carbon credits to offset any carbon we do emit. So we will be net zero from 2029. Aren't we great? Aren't we green? Aren't we clean and wonderful? Come and buy from us, come and invest in us. That's all great, but that's going to cost some money. So the question is, do they have to make a provision as a result of the announcement? And the answer, as is the answer to all good accounting technical questions, is it depends. But what it depends on in this case is the nature of the commitment they're making. So 2 questions. Firstly, have they stated an aspiration or have they made a commitment? If they've made a commitment, then that's potentially something that they need to disclose in the financial statements, particularly in this situation where they've committed to buying a whole lot of new, greener, cleaner property, plant and equipment. So there's definitely commitment there, but is there a need to recognize a provision? And for this fact pattern, the answer was no. Reason is, what are they doing? Firstly, they're buying a lot of new equipment. Purchase of new PP&E isn't onerous, it isn't a liability in any way. It should be a good thing that makes your business better and more efficient. So you might disclose a commitment, but you wouldn't recognize a provision for that. What about the carbon emissions from 2029 onwards that they're going to have to offset? There's no direct economic benefit for that, so that's an onerous obligation. But the key is, what's the obligating event there? And the answer is that the obligating event is so only when carbon is emitted from 2029 onwards. So I actually would have to make a provision here, but not until 1st of January 2029. From that date onwards, whenever I start emitting carbon, I'm going to have to provide the carbon credits I'm going to have to buy to offset that. But it's only when I actually emit the carbon that I have an obligation and therefore a provision. Until then, no provision to be recognised now. The other IFRIC Agenda decision was one on business combinations, and what it confirmed was that if I have a business combination, I pay consideration to the vendors, but that consideration is dependent on future service. So in this example, they've got to stay with the company for 3 years after the acquisition in order to receive it, then that isn't consideration for the business combination. It's actually remuneration for the employment during those 3 years. And therefore, it has to be expensed over those 3 years. It can't be capitalized as part of goodwill. Okay, next one I'll skip over because it's a little bit niche, and I do want to touch briefly on ASIC focus areas. So ASIC, the regulator, puts out a list of focus areas in June every year. And what are they focusing on at the moment? First thing to say is what ASIC have got a lot better at in recent years is non-lodgement of financial statements. They're cracking down pretty hard on that. If I went 5 or 10 years ago, basically they prosecuted one company every year to kind of frighten everyone else into lodging financial statements. Now they've got a lot better at actually finding data on, and I know they do data matching with other registers and with information from the ATO. And that makes it fairly easy for them to find large proprietary companies that are not lodging financial statements. So they're now prosecuting well over 50 companies a year. Those companies are getting fines, they're getting named and shamed publicly, they end up spending lots of money on lawyers, and then they still have to lodge their financial statements anyway. So I know it has been a thing in the past for companies that become large to basically not lodge financial statements, and I hope that no one notices. That was a questionable strategy before. It's now a very bad strategy because ASIC will find you, and they will fine you, and they will make you lodge all of the financial statements that you should have done anyway. So don't try that. In terms of ASIC's focus areas for 30th of June, largely I could have probably copied this slide from the same presentation last year because they aren't particularly new. It has the main areas of focus have been always disclosure in the OFR, impairment, and also solvency and going concern assessments. So there's nothing particularly new there. What I did want to talk about was ASIC's financial reporting surveillance program. So ASIC have a team of people whose job is to do nothing but review financial statements that are lodged with ASIC and check whether they're complying with accounting standards. So look, if you thought your job was boring, at least you don't have that job. But it's a fairly active team. They review about 300 sets every year. They used to focus primarily on listed companies, but they're actually focusing increasingly on private companies as well. And the way it works is that if ASIC review your financial statements, if they're happy with them, you might never know they've done it. But if they find something they have questions about, they will write to the directors and basically say, please explain. Then there's some correspondence back and forth. There's some correspondence back and forth, and then either they'll be happy with it and go away, or they will decide there is something wrong, and you may end up having to restate your financial statements or correct it in the next year. And you don't want to be in that position, because when that happens, ASIC put out what I call a self-congratulatory media release. That basically says, we've made XYZ company change their financial statements as a result of our surveillance activity. Aren't we great? Look what they've had to do. And the reason you don't want to do that is obviously you're publicly available, publicly named and shamed, And what that means is that people like me can make slides like this, which goes through everyone who's been caught by ASIC's media releases. Now, I won't go through all of these. I'll just highlight a couple of them. The first one was Southern Steel, which was previously grandfathered entry. Grandfathering was a thing under the Corps Act that came to an end last year, that basically let about 2,000 companies never lodge financial statements publicly, no matter how large they got. You don't need to know the criteria for it because they no longer exist. But what one company tried to do was issue their first year's financial report without any comparative, to stop their competitors from seeing how their business had changed in performance. No, you can't do that. Accounting standards do require you to include comparatives in your financial statements. So ASIC basically told them to take their financial statements and try again. The other one I wanted to mention was probably the bottom one, Naomi Cotton. And what they got pinged for was a lack of disclosure in the operating and financial review around material business risks, including climate risks. They basically said they didn't have any. Well, the clue's in the name there. Cotton, they were actually into cotton farming. Cotton farming is one of the most water-intensive forms of agriculture there is. It's a lot of issues in the Murray-Darling Basin and so on due to cotton farming. So the idea is that they don't have any material risks due to climate change is, let's say, very questionable. So ASIC challenged them on that, and they ended up having to put a whole lot of extra disclosure to the market, and also will include additional disclosure in subsequent reports. So that's why, again, I do highlight the operating and financial review. ASIC are really going again after companies that disclose that they don't have any material business risks. That's probably not a credible disclosure to make to the market. If you're not disclosing material business risk at the moment, do rethink your operating and financial review. Okay, now that's everything I had in the presentation. We do have a couple of questions that have come through that I'll get onto in a moment, but do feel free while I'm talking to type any further questions you have into the Q&A box, and I will do my best to answer them. So the first question we had was about if you don't qualify for any of the groups 1 to 3 in mandatory climate reporting, does that mean you don't need to do any climate risk reporting or disclosure? The answer is yes there, but sort of. You may not qualify for mandatory climate reporting yourself, but I would emphasize what we talked about earlier. All of your customers, all of your suppliers that do qualify for mandatory reporting will be asking you for data. So you may not have to do reporting yourself, but you will undoubtedly be affected. Did you have anything to add on that, Catherine?
No, you, Ralph, you're correct. I guess the comment here is for junior explorers. It's this new language that all businesses are going to have to become conversant in because it's being integrated in those tier 1 mining companies. It's becoming part of the tendering processing and procurement processes. So this is where where every company is going to get scooped up in this whole kind of transformation as Group 1 reporters actually have to disclose on this information. So it is getting integrated into organisations, obviously starting at the top end of town, but ultimately the intention of these disclosures is really to drag all other organisations along in some form of or another. So in terms of why junior explorers would start sort of thinking around how they can engage in climate or ESG more broadly, there's opportunities there for junior explorers to start talking about, to attract investment essentially into what their proposed project looks like and how are they going to, I guess, engage in certain types of energy requirements to run that project. So it's really important that junior miners start thinking about ESG and climate from the very beginning.
Okay, a few other questions come through. Firstly, a nice easy one. Can we have a copy of the slides? Yes, there will be a post-event email that goes around, and we'll share a copy of the slides with you. Next question I had was, if you're a small company in Australia, but overseas, you have an overseas parent, you can notify ASIC of non-lodgement of your financial report in the year. Do you need to notify ASIC every year? And the answer is no. You lodge a form called I think it's form 382 from memory, and that's a once-off. You wouldn't generally have to repeat that lodgement every year once you've taken advantage of that exemption. The next question I had was on breaches of loan covenants. If there's a breached covenant prior to year end, you're required to reclassify the loan to current. Would this also impact the measurement of the associated borrowing costs capitalized? And the answer, as with all technical questions, is maybe. It would really depend on the potential impact of the loan covenants breach. If it's just a breach and the bank is probably going to waive the breach and renew the loan, albeit after year end, so you still have to disclose as current, then you wouldn't have to change the way you apply the effective interest method to basically recognize borrowing costs over the term of the loan. If, on the other hand, you're in a situation where you've breached a covenant and your bank is now recalling the loan immediately, potentially, then yes, you are going to have to restate the liability to the amount that's being recalled by the bank. So if there's any arrangement fees capitalizing that haven't been fully unwound through the effective interest method yet, then potentially there is a one-off expense there as a result of the breach, and therefore the loan being recalled before the end of the loan's term. Okay, is the recording of the presentation shared along with the slides? The questions come through. Yes, we do record this presentation, so we can share it. I think we also usually put it on YouTube as well, so look out for us there. But yeah, we absolutely will share both the slides and the recording. Okay, no further questions have come through, so thank you very much for your participation and your attendance, everyone. If you do have any further questions later, do feel free to get in touch with us. Very happy to talk to you if you do have questions that occur to you at a later date. But other than that, thank you very much, everyone, and happy financial reporting season. Okay, goodbye.
Thanks, everyone. Bye.